John has $1 million ready to invest, and he's not asking the usual questions. He already knows index funds work. What he wants to know is much more specific. How fast can this $1 million realistically turn into $2 million if he simply lets it compound? In this video, we're counting down the top 5 Vanguard index funds, starting with the most balanced approach and finishing with the fastest. For each fund, we'll walk through what it holds, how it creates growth and dividends, and most importantly, how many years it could take for John's $1 million to reach $2 million. And at the end, we'll look at the fund that stands out the most, the one with the potential to double his money in just 4 years. Index funds often get grouped together, but they don't all behave the same way. Some are built for long-term stability and smoother returns, while others are designed to push growth harder and move faster. Picking the right index fund is all about understanding how different strategies compound over time. The 5 Vanguard index funds in this breakdown were chosen based on growth potential, dividend behavior, sector exposure, and how aggressively they've historically compounded. With that framework in place, it's time to put John's $1 million to work. We'll start at number 5 and move step by step toward the fund that doubles his money the fastest. The rules stay the same throughout. Dividends are reinvested, no additional contributions are made, and taxes are left out under the assumption that this investment sits in a tax-advantaged account. With that set, number 5 on John's list is the Vanguard Target Retirement 2060 Fund, ticker VTTSX. This fund is designed for one thing above everything else, making investing feel easy. It's built for people who don't want to think about allocation, rebalancing, or adjusting risk over time. Once the money goes in, the fund handles the rest. The convenience comes with a clear trade-off, though. VTTSX is not built for speed, it's built for stability. Inside the fund, John's money is spread across U.S. stocks, international stocks, and bonds. Early on, stocks do most of the work, but bonds are always part of the mix. Over time, the fund automatically shifts more money towards bonds to reduce volatility as the target retirement year approaches. That glide path smooths out the ride, but it also puts a natural speed limit on how fast the portfolio can grow. When you look at the income side, the dividend yield sits around 1.82%. That produces steady cash flow, but this isn't a high-income strategy. Dividend growth has averaged about 7% per year, which means payouts have been increasing at a healthy but measured pace. Helpful, yes, but not aggressive. The main engine here is price growth, and that has averaged about 8.12% annually, consistent, reliable, and very patient. So what does that mean for John's $1 million in real terms? If John invests the full $1 million today, the first year sets the tone. After year 1, the portfolio grows to about $1,099,400. By year 5, the compounding becomes easier to notice. The balance reaches roughly $1,603,180, driven by a mix of capital appreciation and more than $108,000 in cumulative dividends quietly stacking underneath the surface. In year 7, John is clearly in range. The portfolio climbs to about $1,933,881. Then, in year 8, the milestone arrives. The account crosses $2 million, reaching roughly $2,123,440. That 8-year timeline shows exactly what this fund delivers: steady progress at a slower pace. It reduces stress and volatility, but it also asks John to wait longer than any other option on this list. And once he sees that number on the calendar, a natural question starts to form. If removing bonds and leaning more heavily into stocks can shave off some time, what happens if he goes all the way and owns the entire U.S. stock market instead? That question takes us to number 4. And number 4 on John's list is the Vanguard Institutional Stock Market Index Fund, ticker VITPX. This is where the strategy clearly shifts gears. Unlike the retirement fund, VITPX doesn't try to smooth the ride with bonds or gradually dial back risk. It goes all in on stocks. The idea here is simple. If you want faster growth, you need full exposure to the market that actually produces it. What John owns inside this fund is the entire U.S. stock market in one package. Large companies, mid-sized businesses, and small firms are all included. When a company grows, it naturally becomes a bigger part of the fund. When it shrinks, its weight fades. There's no opinion, no manager trying to guess the future. The market itself constantly reshapes the portfolio, which keeps John invested in whatever is working at the time. On the income side, the numbers already look different. The dividend yield sits around 2.3%, which is noticeably higher than the retirement fund. More importantly, dividend growth has averaged about 10.95% per year. That means reinvested dividends start compounding faster, adding momentum early on. Price appreciation has averaged roughly 9.12% annually, which doesn't sound dramatic on its own, but when you combine it with growing dividends and full stock exposure, the timeline starts to compress. So how much time does that actually save John? Well, if John invests $1 million into VITPX, after year one, the portfolio grows to about $1,114,200. By year 5, the account reaches roughly $1,723,795, supported by more than $150,000 in cumulative reinvested dividends, alongside capital appreciation. Then, in year 7, John hits the milestone. The portfolio climbs past $2 million, reaching about $2,149,272. Instead of waiting 8 years like the retirement fund, this full market approach gets him there in 7. But now John notices something else. If owning the entire market can cut the timeline to 7 years, what happens if he narrows the focus to just the biggest, most profitable companies? That thought naturally leads him to the next step on the list, and to number 3. And remember, in the end, I'll show you John's top pick, the one with the potential to turn $1 million into $2 million in just 4 years. But first, number 3 on the list is the Vanguard 500 Index Fund, ticker VFIAX. This is where the lineup starts to feel noticeably faster. VFIAX steps away from owning everything and instead concentrates on the companies that already dominate the U.S. economy. Rather than owning thousands of stocks, John is now focused on the largest and most profitable businesses in the country. That narrower focus is intentional. It's designed to trade broad exposure for faster growth. Inside this fund are the 500 largest U.S. companies, weighted by market value. When a company performs well, its weight naturally increases. When it falls behind, it shrinks inside the index. Success earns more influence, which means the fund constantly leans towards what's already working in the market. Over long periods of time, that bias has mattered. The income profile reflects that shift. The dividend yield sits around 1.11%, lower than the total market fund. Dividend growth has averaged about 5.59% per year, which is typical for large established companies that focus more on reinvesting profits than rapidly raising payouts. In this fund, dividends help, but they're not the star of the show. The real driver is price growth, and that has averaged about 12.37% annually. So what does that change for John's timeline? Well, with $1 million invested in VFIAX, the acceleration shows up early. After year 1, the portfolio grows to about $1,134,800 as price growth does most of the work. By year 5, compounding is clearly ahead of the total market fund. The balance reaches roughly $1,870,263, with growth continuing to pull away. Then in year 6, John hits the milestone. The portfolio crosses $2 million, reaching about $2,116,229. That's a full year faster than the total market approach, driven by a tighter focus on large cap leaders. So then, John asks, if focusing on large cap leaders can cut the timeline to 6 years, what happens when growth becomes the primary objective and income takes a back seat entirely? That curiosity pushes John toward the next fund on the list, and at number 2, we have the Vanguard Mega Cap Growth Index Fund, ticker VMGAX. At this point, the strategy becomes very clear. VMGAX is not trying to balance growth and income. It's not trying to smooth out volatility. This fund exists for one reason: to grow as fast as possible by concentrating on the largest growth-focused companies in the market. John is now making a deliberate trade. He's giving up comfort and income in exchange for speed. Inside the fund are mega-cap growth businesses that already dominate their industries. These are companies built around technology, platforms, and scalable products where revenue can grow quickly without costs rising at the same pace. Because the fund is more concentrated, each holding matters more. When these companies perform well, the portfolio moves fast. When they don't, the swings are more noticeable. That focus shows up immediately in the numbers. The dividend yield is only about 0.39%, which tells you income is almost irrelevant here. Dividend growth has actually averaged slightly negative at around negative 0.37%, reinforcing the idea that these companies prefer reinvesting cash back into growth rather than paying it out. That's not a flaw, that's just how fast-moving businesses innovate. The real headline is price appreciation, which has averaged about 16.45% per year. So what does that do to the timeline? With $1 million invested in VMGAX, the acceleration is immediate. After year 1, the portfolio jumps to about $1,168,400. That early move comes almost entirely from price growth, not dividends, which tells you right away what kind of fund this is. By year 3, the balance climbs to roughly $1,592,516, and growth is now compounding on top of already large gains. In year 4, the portfolio reaches about $1,858,060, and in year 5, the account grows to roughly $2,167,179, doubling his original investment in just 5 years. That's a major shift. Just a few steps back, 8 years felt normal. Well, now the timeline has been slashed nearly in half and is 3 years faster. The trade-off is volatility. Along the way, this fund will experience bigger swings, both up and down. But if John's only question is speed, VMGAX delivers a clear answer. And yet, one final question remains. If concentrating on mega-cap growth companies can get the job done in 5 years, what happens if he goes one step further and focuses entirely on the fastest-growing sector in the market? And that brings us to number 1 on the list, the Vanguard Information Technology Index Fund, ticker VITAX. This is the fastest option in the lineup, and it's built with zero concern for comfort. VITAX doesn't try to balance sectors or smooth volatility. It does one thing extremely well. It concentrates on the part of the economy that has historically grown the fastest. If speed is the only metric that matters, this is where John ends up. Inside the fund are technology and innovation-driven companies that power modern life. Software platforms, semiconductor manufacturers, cloud infrastructure providers, and digital services all sit at its core. These are businesses that can scale quickly, dominate entire industries, and compound earnings at a pace few other sectors can match. That concentration is exactly why this fund behaves so differently from the others. The income numbers make that clear immediately. The dividend yield is about 0.41%, essentially negligible. Dividend growth has averaged negative 3.75%, which reflects that these companies prefer reinvesting cash back into expansion rather than paying it out. Just like the previous fund, income isn't the point here, growth is. And on that front, VITAX stands apart. Average share price appreciation has been about 21.35% per year over the last decade, the highest of any fund on this list. So how fast does that actually get John to his goal? With $1 million invested in VITAX, after year one, the portfolio is projected to be around $1,217,600, driven almost entirely by price growth. By year two, the balance climbs to roughly $1,481,297, with compounding already building on top of strong early gains. In year three, the momentum continues to stack. The portfolio reaches about $1,800,961. Then, in year four, the account grows to roughly $2,188,568, surging past the $2 million mark faster than any other fund on the list. When you read the timeline from the longest to shortest, the pattern becomes very clear. The slowest path belongs to VTTSX, the Target Retirement Fund. It doesn't reach the $2 million mark until year 8, prioritizing stability and diversification over speed. Next is VITPX, the Total U.S. Stock Market Fund. With full equity exposure but no concentration, it gets there in year 7. After that comes VFIAX, the S&P 500 Fund. By focusing on large cap leaders, it shortens the wait and crosses the line in year 6. Then there's VMGAX, the Mega Cap Growth Fund. With growth taking priority over income, it reaches $2 million in year 5. And finally, at the end of the chart is VITAX. Compared to VTTSX, it slashes the doubling timeline in half, hitting the target in year 4, faster than any other option on the list. These numbers are incredible, no doubt, but not everyone has $1 million to start with. There's actually an even easier way to reach a reasonable goal. Click the video on the screen to find out how to make $7,000 per month with only $20 a week.